name is Nurul Alias. So today I would like to explain the justification of company selection. So as you can see, Top Glove Corporation Berhad and Hartalega Holding Berhad were selected because they are among the leading rubber glove manufacturers in Malaysia and globally. So both companies operate in the same industry, making it easier for us to compare their financial performance, their ratio, business strategies, and competitiveness. So the companies differ in areas such as production capacity, technology, market share, and management strategies, which provide a meaningful comparison. So their performance was significantly affected before and after the COVID-19 pandemic, so making them suitable for analyzing the impact of market changes and economic conditions.
Hello, my name is Azalaili. I would like to introduce Top Gloves Company, the world's largest rubber glove manufacturer. The company was established in 1991 in Malaysia by Tan Sri Dr. Lim Wee Chai and Puan Sri Tong Subi. From a very small local business, Top Gloves has grown into a global leader in the glove industry. Today, the company has not only operates manufacturing plants in Malaysia, but also in Thailand, Vietnam, and China as well. Their products are supplied to customers in more than 195 countries around the world. Top Gloves continues to strengthen its position by focusing on three key areas, which is innovation, the way they develop better products to attract more customers and consumers. Next, operational efficiency, where they work really hard just to improve productivity and reduce costs in the company. And lastly, the company sustain the business practice just to ensure long-term growth while caring for the environment and also society. Next, I would like to introduce about Hartalega Holding Berhad, a leading global manufacturer of the trial examination gloves. The company was established in 1988 in Malaysia by Kwan Kam Hon and its headquarters in Kuala Lumpur. Over the years, Hartalega has grown from a local glove manufacturer into an internationally recognized company. Today, Hartalega exports its products to more than 70 countries worldwide, serving healthcare and industrial customers across the globe. This company is well known for its technological innovation, also making high-quality products and advanced manufacturing technologies. These strengths have helped Hartalega achieve strong growth and maintain its position as one of the leading glove manufacturers in the world.
So next, I would like to explain the trend analysis. So this trend analysis evaluates the financial performance of Top Glove Corporation Berhad and Hartalega Holdings Berhad using the liquidity ratio, profitability ratio, activity ratio, and leverage ratio. So the analysis helps to compare the company's financial strength, operational efficiency, profitability, and debt management over the selected years. Next, I would like to explain the liquidity ratio. So the first one is a current ratio, which is current asset divided by current liability. So as you can see from the graph and the tables, Hartalega recorded a stronger liquidity position than Top Glove throughout the 5-year period. So in 2021 and 2022, Hartalega maintained higher current ratio, showing a better ability to meet short-term obligations. So the largest gap occurred in 2023, where Hartalega achieved 6.67 times compared to Top Glove 1.83 times, indicating significantly stronger liquidity. So although Hartalega current ratio slightly declined in 2024 and 2025, it remained consistently higher than Top Glove. And Top Glove current ratio remained relatively stable between 1.83 and 2.12 times over the 5-year, which is 2021 until 2025. And overall, Hartalega demonstrated a better short-term financial strength and greater financial flexibility compared to the Top Glove. So the second one is quick ratio, which is current asset minus inventory minus prepayment and divided by current liability. So again, as you can see from the graph and the table, Top Glove quick ratio declined from 2021 to 2023. So it is indicating a weaker liquidity performance during that period. And the company showed improvement in 2024 and continued to strengthen in 2025. So despite fluctuation, Top Glove maintained a quick ratio above 1, showing its ability to meet short-term obligations. And as you can see, Hartalega recorded consistently higher quick ratio throughout the 5 year, which is 2021 until 2025. And Hartalega experienced strong growth in 2022 and reached a significant increase in 2023 before declining slightly in 2024 and 2025. And Hartalega demonstrated a stronger liquidity, better financial stability, and a greater ability to cover short-term debt compared to Top Glove. So the last one is a net working capital, which is current asset minus current liability. And from the graph and the tables, both Top Glove and Hartalega maintain a positive net working capital for more of the 5-year period. So positive working capital indicates both companies were able to meet short-term financial obligations. Strong working capital performance in 2021 and 2022 was mainly driven by high demand of medical gloves during the COVID-19 pandemic. So Hartalega consistently recorded higher than net working capital, reflecting stronger short-term financial strength. After the pandemic, the glove industry faced challenges such as oversupply, lower selling prices, and reduced profitability. Despite these challenges, both companies remain financially stable and continue to maintain a positive working capital. Hartalega shows stronger, again, liquidity performance, while Top Glove demonstrated recovery in the later years.
Next, I will explain the activity ratios between these two companies, which is Top Gloves and Hartalega. First, it is being called as Total Assets Turnover Ratio or TATO. This ratio measures how effectively a company uses its assets to generate sales revenue. The formula for TATO is net sales divided by total assets. A higher TATO ratio indicates that the company is using its assets more efficiently to generate sales. In other words, every ringgit invested in assets is producing more revenue for the company. This ratio is important because it helps evaluate how well management utilize company assets in daily operations. Companies with higher asset turnover ratios are generally considered more efficient than companies with lower ratios, as they can generate more sales from the same amount of assets. Based on the analysis from 2021 to 2025, the total assets turnover ratio shows how efficiently a company uses its assets to generate sales revenue. For Top Glove, the ratio decreased significantly from 1.67 times in 2021 to 0.28 times in 2023 before improving to 0.5 times in 2025. Similarly, Hartalega recorded a decline from 2.02 times in 2021 to 0.39 times in 2023 and then recovered to 0.55 times in 2025. This decline happened mainly because glove demand and selling prices dropped after the COVID-19 pandemic. In addition, both companies face excess production capacity which reduced their efficiency in using assets. When comparing the two companies, Hartalega generally had a higher total assets turnover ratio than Top Glove, which means Hartalega was more efficient in generating sales from its assets. However, both companies show improvement in 2024 and 2025. This suggests that assets utilization efficiency is gradually recovering as the global glove industry continues to improve. In conclusion, Hartalega performed slightly better than Top Glove in assets utilizations, while both companies experienced recovery after the post-pandemic slowdown. Next, I will explain the inventory turnover ratio. This ratio measures how many times a company sells and replaces its inventory during a specific period. The formula is cost of goods sold are divided by average inventory. Inventory turnover helps us to evaluate how efficiently a company manages its inventory. A higher ratio means inventory is sold quickly, indicating strong sales and effective inventory management. On the other hand, a lower ratio may indicate slow-moving inventory, weaker demand, or excess stock. Therefore, this ratio is important because it shows how efficiently a company converts its inventory into sales and manage its stock level. Analysis given is the inventory turnover ratio that measures on how efficiently a company manages and sells its inventory during a financial year. For Top Glove, the ratio decreased from 14.5 times in 2021 to 8.5 times in 2025. The decline was mainly due to lower glove demand and oversupply in the market after the COVID-19 pandemic. However, the company showed a strong recovery in 2024 and 2025. Similarly, Hartalega experienced a decline in inventory turnover from 12.8 times in 2021 to 6.7 times in 2025. This was also affected by reduced demand and changing market conditions. When comparing both companies, Top Glove maintained a higher inventory turnover ratio than Hartalega throughout most of the period. This indicates that Top Glove was generally more efficient in selling its inventory and managing stock levels. The improvements seen in both companies during 2024 and 2025 suggest that their inventory management became more effective as the global glove industry gradually recovered. In conclusion, Top Glove performed better in inventory management, while both companies show signs of recovery as market conditions improve.
For the next part, we are looking at a comparative profitability analysis of two major glove manufacturers, Hartalega Holding Berhad and Top Glove Corporation Berhad. Covering the period of 2021 to 2025, we will examine how this company managed their earnings through the post-pandemic market shift. Let's start with the gross profit margin, which show the efficiency of production. In 2021, both companies were nearly equal, with Hartalega at 61.13% and Top Glove at 60.02%. However, as demand normalized, Hartalega showed more stability by 2025. Hartalega maintained a GPM of 23.98%, whereas Top Glove fell to 15.04%. Notably, Top Glove had a massive but brief spike to 95.06% in 2022 before sharply declining. Moving to the bottom line, the net profit margin revealed a stark contrast in resilience. While Top Glove started strong in 2021 at 45.89%, they suffered significant loss in 2023 and 2024, with margin dipping to negative 10.43% and 16.117% respectively. Hartalega managed to stay in the black throughout the period ending of 2025 with a 10% net profit margin compared to Top Glove recovery of 3.98%. In terms of asset efficiency, Hartalega ROA remained positive across all 5 years, though it dropped from a high of 37.73% in 2022 to 3.02% in 2025. Top Glove struggled in this area as well, recording negative return on their asset in 2023 and 2024 before returning to a slim 0.81% in 2025. For our shareholder, ROE is a critical metric. Hartalega provide a more stable return, peaking at 42.83% in 2022 and settling at 3.80% in 2025. Top Glove ROE was a volatile, crashing from 42.31% in 2021 to a negative return during their loss-making year in 2023 and 2024, eventually reaching 1.14% in 2025. In summary, while both companies faced challenges from decreasing demand and post-pandemic market conditions, Hartalega profitability was significantly more stable. Top Glove performance was hit harder by operational inefficiencies and financial loss during 2023 and 2024. As of 2025, both are showing signs of improvement, but Hartalega remained the stronger performer in terms of earning and financial stability.
Hi, I'm Nurai Miti Ahmad. Today I will represent the leverage ratio analysis of Hartalega Holding Berhad and Top Glove Corporation Berhad from 2021 until 2025. Okay, for this analysis, help us understand how much debt each company use in financial, its operations, and the level of financial risk faced by the company. Leverage ratio is a financial ratio used to measure the extent to which a company relies on the debt financing. It is important because it shows the company's financial risk and a long-term solvency. Generally, a lower leverage ratio indicates a stronger financial stability and less dependence on external borrowing. For Hartalega, the leverage ratio remained relatively low over the 5 years period. The highest ratio was recorded in 2022 at 0.23 times, while the lowest was in the 2024 at only 0.05 times. This indicates that Hartalega relied more on equity financing and maintain a conservative capital structure. For Top Glove, show a declining leverage ratio from 0.35 times in 2021 to only 0.06 times in 2025. This suggests that the company gradually reduced its dependence on debt financing and improve its financing position over the years. When comparing both companies, Hartalega generally recorded lower leverage ratio than Top Glove. This suggests that Hartalega had lower financing risk and stronger financing flexibility, while Top Glove started with the highest leverage ratio. It successfully reduced its debt exposure over time. In conclusion, both Hartalega and Top Glove maintained relatively healthy leverage ratio during the period of analysis. However, Hartalega demonstrated stronger financial stability due to its leverage over time. Overall, lower leverage ratio indicates lower financial risk and stronger financial health. Okay, thank you. That's all for our presentation today, and thank you.